what are central banks doing? They just had the highest amount in the quarter for the entire year of 2024 in terms of buying gold. Maybe it's cut back a teeny weeny bit, but spot gold is higher in every single currency. And we just came through very high interest rates. So where was that competition? Another part of it is, if you listen to the talking heads on any of these news channels, things aren't working the way they usually work, because we're at the end of this currency's life cycle. And the more people, like the central banks on a global basis, have certainly recognized that. That's why they're piling into gold. They don't care that the rates are higher, so you get a little bit of interest.
Central banks have been ramping up their gold purchases, marking the highest quarterly buying spree of 2024. Despite high interest rates, gold prices have risen across all major currencies, defying traditional market expectations. Analysts note that this unprecedented behavior reflects a broader recognition among global central banks. The current fiat currency system is nearing the end of its life cycle. Their aggressive accumulation of gold signals a strategic shift, prioritizing long-term stability over short-term gains from higher interest rates. Lynette Zang, a highly respected financial analyst, educator, and strategist, explains that the gold market operates in two distinct realms: the physical market, governed by actual supply and demand, and the spot market, heavily influenced by derivative contracts. While physical gold represents tangible assets, the spot market is dominated by paper contracts. This enables market manipulation, suppressing gold prices to maintain confidence in fiat currencies. Rising gold prices historically signal failing government-backed currencies, a reality central banks aim to obscure by inflating derivative markets to dilute gold's perceived value. Speaker Lynette Zang exposes that central banks and institutions are increasingly introducing smaller, more accessible contracts, such as micro and macro contracts, to attract retail investors. However, these contracts are disconnected from physical gold and cannot be converted into tangible assets, misleading participants into believing they own gold, keeping the broader public away from tangible assets while enabling central banks to control market perception and suppress prices amid growing demand for gold as a hedge against systemic risks. We're about to explore the video, but first, subscribe and hit the bell icon to keep up with our newest uploads. Your feedback in the comments is always appreciated.
There is gold, there's fiat gold, there's gold, digital gold that does not exist, and there is the spot market contract, which is what most people are referring to when you're saying it's going up or down. And then there's the physical market, which is a true supply and demand market. So there are two different markets. Let's talk about the spot market, because we do know that a rising gold price is an indication of a failing fiat currency, a failing government-based currency. And they don't want you to understand that. So as they devalue and depreciate the currency, well, you get the stock markets that go up because they're printing, they're just doing this, easy money. And so we'll see the markets that they've targeted for inflation go up. But gold is a market that they have targeted to suppress its value. And they can create and do as much physical gold or as much gold and silver as they want to through derivative contracts. And derivatives are just big bets, right? But I want you guys to understand this really, really clearly, that this whole money market is a con game. And con games require confidence, and they also require new money coming in all the time. And when they use these derivatives, these paper contracts to create gold, it looks like out in the marketplace that there's all of this gold that there isn't. So the CME, the Chicago Mercantile Exchange, and they create a whole bunch of these derivative contracts. So there used to be a 500-ounce gold contract. Well, now there's a 100-ounce gold contract. It's much cheaper to buy that than to buy 100 ounces of gold, right? So in theory, you can convert that contract and take delivery of that underlying gold. But again, markets, con games always need new participants. So the CME brought out a micro, macro macro contract that instead of it being 100 ounces is 10 ounces. But you cannot convert that into the physical underlying gold. There isn't even that thought that you might be able to do it. And that had this year so far for 2024 in both the gold and the silver macro contracts soared. I mean, more than ever. So that means that there was a whole lot of gold that was created through these contracts without even the concern that any of them were going to convert into the underlying physical. No concern about that at all. But if I remember correctly, and I don't have these numbers in front of it, I'm pretty sure that they created over 1 million ounces of silver through those macro contracts. And then I think it was something like, now they're trying to bring out a 1 ounce contract. And of course, you're not going to be able to convert that. But what they're doing is they are lowering the barrier to entry, making it less and less expensive. So people think they're buying gold. They're not buying gold. They're buying something that is pegged to the spot market contract. So they're using a contract against a contract. And in that case, it has not been formally legalized yet, but they're anticipating this to come out in January. What they're doing is they're misdirecting people away from the physical like this into the contract. How much more gold can they create? Well, they're doing it because there's surging demand. And they don't want the little guy owning gold, owning real gold in really any of these coin forms.
Under President Trump's administration, the U.S. is positioning itself as a global crypto hub, with policies favoring deregulation and a trading-focused economy. His cabinet includes pro-trading figures, and his leadership has influenced market dynamics, with Bitcoin surpassing $100,000 due to a risk-on environment. Mergers and acquisitions are thriving, fueled by private equity and leveraged financial instruments like CLOs. At the same time, easy money policies continue to drive market activity despite claims of tightening by the Federal Reserve. The Financial Stability Report 2024 highlights a disconnect between geopolitical tensions, high market valuations, and investor complacency. Lynette Zang highlights that deregulation has enabled larger entities to consolidate power through mergers. Despite official narratives, data shows that easy money policies persist, fostering inflation and amplifying market risks. Investors are navigating this trading-centric market, focusing on tangible assets like physical gold, while paper markets remain dominated by speculative activity. Lynette Zang also makes some predictions that inflation is expected to surge significantly in 2025, potentially reaching levels that are impossible to ignore. Drawing parallels to Venezuela's hyperinflation era, where soaring stock markets masked economic collapse, the U.S. could face a similar dynamic. New rounds of money printing are likely to fuel inflated markets even as underlying valuations remain weak. Meanwhile, U.S. interest rates are anticipated to drop, aligning with global trends, as policymakers aim to sustain inflation. While this may temporarily buoy markets, the resulting inflationary pressures could erode the remaining confidence in the economy. Now, let's shift our attention towards the interview.
Definitely, President Trump wants to be the crypto capital of the world. He owns a crypto company. He's putting in entities in his cabinet that support his trading mentality. And so, yes, you would see the funds that would have gone into even just the digital markets. You've seen them go to other places, and we've seen Bitcoin go away above 100,000 an ounce because of all of this risk on. Also, mergers and acquisitions. There are the entities that would oversee that before are much more prone to allow certain mergers and acquisitions to go on. And there's an awful lot of private equity money floating around. This is either through all sorts of, CLOs, which are derivatives. So they just create a whole lot of leverage and a whole lot more money. And it's still an easy money policy. And so if the Federal Reserve does indeed lower the rates coming up or into the future, it doesn't matter. They never really tightened policy. They just said that they tightened policy. But their data, the financial stability report from 2024, is really talking about that disconnect between geopolitical moves and the high valuations and market complacency. So it's risk on, baby. And President Trump's son said just recently that the party's just getting started. So if this is a trading mentality and a trading market, there's a physical market and there's a paper market. So what we're really referring to is the paper market, because I'm not rushing to sell my gold because it's risk on, right? But then what I own is physical. I don't own the paper gold. I just own real gold. But that's really what's happening in here, is that this is such a trading market, and the support is in there for a lot more deregulation, a lot more mergers and acquisitions, meaning the biggers are going to get even biggers, and the opportunity for private equity that has been thriving since at least 2000, and I think it's 2013 is when that market really started to take off in a very big way because of all the, because of all the easy money policy. And that really hasn't gone away regardless of what they want you to believe. You look at the data, their data, not my data. Look at their data. They admit easy money policy, and we're easing into an easy money policy. That means a lot more inflation. And we're still going to export that all around the world. I think inflation is definitely going to heat up in 2025. And I think it's going to heat up to a very noticeable level. And so I think these markets, we're in the melt up phase. If you look at a country like Venezuela in 2013, 14, 15, 16, they had the best stock market in the world, but they also had the hyperinflation. And so in 2025, I think we're going to see very, very high inflation. And I think that's going to destroy, I don't know if that'll be enough to kill the rest of the little bit of confidence that are in here. But you'll see the markets soar because of all the new money printing that's going to go. I think we will see interest rates lowered in the US as we are elsewhere in the world, because they need that inflation. The markets want to implode. They're too overvalued. There's no valuations there. So, yeah, I mean, the biggest thing for me, I think, is the inflation that I believe we're going to see next year. Not going to be pretty.
The shifting dynamics of gold markets, crypto adoption, and inflationary pressures paint a complex picture of global economic trends. Central banks' strategic moves, deregulation in the U.S., and looming inflation highlight the fragility of traditional financial systems and the growing importance of tangible assets like physical gold. Understanding these trends' implications will be critical for navigating the evolving financial landscape. How might central banks' gold accumulation impact global currency stability in the long term? Could deregulation and easy money policies in the U.S. exacerbate market instability in 2025? Please comment below and let us know what you think. If you found this video helpful, please like it and subscribe for more. We're grateful to have you with us on this journey.